Hi folks, and welcome back to Meaningful Money. Okay, I'm still here on Chapel Carn Bray, the most westerly hill in England. It's just a place to film, one of the many beautiful places around where I live, which is why I chose to do these outside. Say a very brief thank you actually. My viewer numbers are going up all the time. It's great. It's 60 views a day now consistently, and I'm really grateful and humbled by that. So thanks, keep watching and keep telling all your friends. We talked last time about giving stuff away and the implications of doing that. Usually people want to give things away for inheritance tax reasons. We talked about how that might or might not work, and also for long-term care reasons. We talked about that too. But there is a third implication, if you like, of giving stuff away which you need to know about, and it's called the pre-owned asset tax rules. But as ever, before we get into the meat of that, my friends down here in the bottom right, Seven Investment Management, firm of investment managers in London. They continue to sponsor me here on Meaningful Money, and I'm extremely grateful to them for doing so. So pre-owned asset tax, how does that work? Well, let's use an example of your property, your house, right? You're living in it at the moment, but it has quite a value, and you've got an inheritance tax problem. So you come up with a bright idea one day that what we'll do is we will sign the house over, give the house to our children. Great idea, okay? But then you realize you need somewhere to live, okay? Bit of a problem. And so you decide that you will give the house to your kids, but continue to live in it. Everyone's a winner, right? Well, not quite. It doesn't quite work as well as that. Because you are giving something away and yet retaining that benefit, the Inland Revenue, or Her Majesty's Revenue and Customs, as I should call them, given their proper name, deem it that you are receiving a benefit. So in property terms, that's fairly easy to work out. Let's say that your property, if it was rented out on the open market, would attract a rental of £1,000 per month. So the Inland Revenue, because presumably you're not paying your kids £1,000 a month in rent, you've given the house to them, so they own it, they are essentially your landlords, but presumably you're not paying them £1,000 a month in rent. And because you're not paying them £1,000 a month in rent, the revenue deems it that you are getting the benefit of that £1,000 a month, and they will tax you accordingly. So £1,000 a month, 12 grand a year, they will add that to your tax, to your income, and tax you accordingly. So you're paying tax on income you haven't had, because more money has landed in your current account. You just haven't spent that on rent. Revenue deems it that you have got the benefit from that. So that's fairly unpleasant. But property is easy to work out because you've got rental value and things like that. What if it's something a little bit less tangible? Let's say you have a painting which you love, valuable painting. Let's say it's worth £100,000. I always make these figures easy for myself, don't I? Well, there is simply a sort of standard rate applied to it, and it's 6.25% of the value of the thing per year. So a £100,000 painting, assuming it's still hanging on your wall, you've given it to your kids, but it's hanging on your wall and you're getting the benefit of it. The revenue will charge you 6.25% of the value of that painting, £6,250 a year. Obviously, there's not many people with 100 grand paintings in their house, but you never know. Nice easy figures. Perhaps I should have used 10,000. Never mind. So do you see what I mean? You can't give something away and continue to receive a benefit. If you do, the revenue will tax it accordingly. Now the alternative is to elect that the gift you have made is a gift with reservation. So you say to the revenue, yes, I have given my house to my children, but I'm going to continue to live in it. I'm therefore giving it, but reserving the right to live in it. That's absolutely fine, but the problem is it just has no merit at all. It doesn't work for inheritance tax because the revenue would just deem that the house is still yours, certainly for calculating inheritance tax. So you've got to ask yourself why you would do it at all. Why give something away, elect for it to be a gift with reservation? There's no benefit to doing that at all, so I have no idea why you would do it. But those are your options and those are your issues. Pre-owned asset tax is a biggie. Hardly anybody knows about it. Certainly I very rarely get clients who know about that. They know about the gift with reservation thing. They know that they can't really give something away and keep a benefit. But they don't know about pre-owned asset tax. Very important. So it's important that you know that, and I think that's it. So I'm going to talk next time about the Retail Distribution Review, a bunch of legislation happening at the end of this year, and specifically I'm going to talk about its implications for the high street and financial advice on the high street in the UK. So thanks for watching this one, and I'll see you next time.